finding tomorrow's strongest stocks today. So we're going to go ahead and get started. This is Gianni DePoce. I'm an instructor over at TheoTRADE, a trading education platform. It's great to be with you all today. We have a lot to talk about. As I mentioned, this is part 2 of a webinar series on how to find the strongest stocks today. So going to run through some really key components on how you can become a breakout trader, as well as incorporate some really powerful swing trading techniques into your trading arsenal to ultimately increase your win rates, minimize your losses, and just become a more accurate trader. You know, we know that you don't have to be right all the time to be a profitable trader, but it does help to have a higher trading accuracy. And I'm going to discuss what my research has shown to be the missing ingredient in all likelihood in your trading process. So we're going to get into that today. Thanks again for joining me. Before we get started, just want to remind you that we are not financial advisors. This is all for your education only. Okay, so nothing that will be shared today is meant to be taken as investment advice. And of course, this is all copyrighted material. So let's go ahead and begin. So I want to tell you a little bit about my story on how I got into trading, because it is a little bit unusual. You can probably tell from my name that I have Italian ancestry. My parents moved here a little bit before I was born, and my father was in the cement business. Shocker, right? So I didn't really grow up around the financial world. But it wasn't just my father in the cement business. My grandfather was too. So I was around a lot of labor types, cement types, builders. And I would always hear the stories from them, oh, this is such back-breaking work. We always valued hard work. But it was always encouraged amongst myself and, my generational cohort in the community to go to school and get an education. So I did. So I actually started off on the path to be a dentist, believe it or not. I can't really imagine myself in that environment today. But I went to university. I actually played college soccer for a couple of years at a small mid-major Division I school. And then I stopped that after a couple of years. And I realized, I think I want to go into the business world. So I switched my major over to finance. Then I switched it over to economics when I realized, hey, I don't have to be a part of the business school to get into the business world. And it's actually less expensive to be an economics student than it is a finance student. So I was an economics student, got my bachelor's in that. Started off actually working at an accounting firm. It's not uncommon for many people in the investment world to start off learning fundamental analysis. And that's where I began. I read the Warren Buffetts and the Benjamin Grahams, security analysis and all that stuff. And, just started watching the markets on a daily basis, realized, these fundamentals, yeah, it makes sense, but why is Apple, this was like in the early 2010s, why are Apple and Amazon, why are those stocks booming so much when their fundamentals, they don't really have that strong of earnings? Yeah, great concepts as companies. Obviously, they've grown quite a bit since then. But I don't understand why these stocks are going up so much. So, I'm doing my work in an accounting firm, learning tax law, learning how to read balance sheets and cash flow statements and all that kind of stuff. And I actually met a local guy at the gym and just chatting with him. And turns out he was a pretty bigwig financial advisor at the time. He's still in the business. And I was in college and I was like, hey, can I drop off my resume one day? So it was kind of a fated encounter in that respect. Just ran into a guy at a local gym. That gym, by the way, was closed after COVID. So a little bit of a sad ending to that building. But so I drop off my resume at this guy's office. I just turned 20. No, actually, I was 19 still at the time. And he gives me a job. And I started studying to take the Series 7. I got my Series 7 when I was 20 years old. I hadn't even graduated from college yet. But I basically started working, I worked 3 jobs while I was in college. I did landscaping. I delivered pizzas, believe it or not. And I did snowplow. I live here in Michigan, so there's no shortage of snowplow to be done in the winter, with the exception of this year. I must say it's really Been a mild winter, probably the most mild winter that I can remember in my life. So glad I'm not doing snowplow anymore. I'm trading stocks and analyzing markets instead. So, I get my Series 7 before I graduate from college even, and then I start, selling stocks. And it was really nice because I started rubbing shoulders with some, big players in the financial industry. I can't tell you how many times I went out to lunch or went to a Detroit Tigers game with portfolio managers and, all these types of people that managed, hundreds of millions, if not billions of dollars. So, here I was, this young 20-year-old kid, not even coming from, a financial family, being exposed to this brand new world. And it was really interesting in the sense that I didn't grow up speaking that language, and I think that that means quite a bit because I learned it from the ground up, right? I didn't really have a mentor when I was a teenager saying, hey, this is how you should start looking at financial markets, and this is how you should do this. No, it was all self-taught. So no matter where you are on your financial journey, whether it's getting a job or building a career or starting a portfolio, I've been there already. So um, I've kind of had quite a bit of an experience in this financial journey over time. But basically I started saving because I realized the power of being in the market. Time in the market matters more than timing the market, but if you can time the market with time in the market, then things start to get interesting. And we're going to talk about that today. Okay. I want you to learn the secret of time when it comes to markets and your portfolio. Okay. So I started working, I started selling a few stocks here and there, got some commission checks. Then I actually got my Series 66, which is the advisory license. So then, you move over from commissions to fees and whatnot, but started saving a few money, got a couple grand in my name. And I started investing it, and over the last decade plus, been in the market now for about 12 years, that portfolio has grown quite a bit. Started off, let's say, a few $1,000s, $5,000. It's well north of 250 now. Okay. And that's just from that original bucket that I started with working. So yeah, there's money that's been added to that portfolio along the way. But it's the money that's been there that has been compounding. And that's the power of growing your wealth. And the main strategy I've used is the one I'm going to share with you today. And it basically encompasses owning the strongest stocks in the strongest sectors, using principles like relative strength, understanding where we are cyclically. I can tell you a really good story real quick about when I started learning cycles. I started learning about cycles back in like 2015, 2016. So I've been working with them for several years now. And I was still working in the industry when we had that Christmas Eve market bottom. December 2018, it was December 24th. The market bottomed on Christmas Eve. And, it was a pretty sharp pullback at the time. It wasn't as bad as the COVID crash of 2020, but, here I am working at this, financial firm, and I was pushing the trades. I was the main trader at this firm. Okay. It was like a $250 million portfolio. So, it was a nice chunk of change, to say the least. And I'm studying cycles. I was only a few years into it, but I knew we were in the time band for something that's called a primary cycle low. And I was not in a senior enough position at that point to actually be making decisions within the portfolio. So it was kind of like I was a soldier, if you will. And when I got the marching orders, I had to press the buttons. And that was actually the moment that day where I realized, man, I cannot be in this business anymore in this current capacity. I want to be in the financial industry, but I can't be selling near the lows. I knew we were in the time band for a primary cycle low. And so I got my marching orders. Hey, we need to raise 20% cash. Mind you, we had already weathered that drawdown during that crash in December. We literally sold the bottom that day. I didn't want to, right? But like I said, I was basically a financial soldier at that time. And hey, you don't push these buttons, you don't get to keep your job. So it was at that moment when I realized, wow, this career path within financial markets is not for me. And I want people to understand the power of cycles. I want you to understand the power of cycles and how you can combine them into picking the strongest stocks and the strongest sectors to compound your portfolio over many years, many years. So, about a year later, I was out. I left the financial industry in January of 2020. It was really December, but the way the calendar worked that year, I ended up staying a couple days into January of 2020. But yeah, it was that moment, December of 2018, when I realized my time in this space is done. I want to start sharing my knowledge with those that are eager to learn and willing to incorporate the study of cycles into their own investment process. So we're going to talk about all that today, and combining that with the breakout strategy. Okay, so it's very simple. There are always stocks that drive the bull market. Okay, there are always investment themes in a bull market. Okay, so right now it's AI, it's tech, right? You had tech in 2000, you had energy in the mid 2000s, you've had Bitcoin booms, you've had precious metal booms. There's always a theme to a bull market, and there are tools and techniques that you can have at your disposal that can help you discover those, if not necessarily ahead of time, but in their very early stages, right? We don't need to buy the absolute bottom and sell the absolute top. But when you know the cycles, you know the general periods where those lows and those highs may culminate. And guess what? There's a lot of meat in the middle that I'm willing to eat to grow my account. And hey, I got a seat at the table. I got a big plate of meat right next to me. It's just you can have a bite, you know? That's what I'm saying. So it's the perfect time to start now to learn this, because if you've been in this market missing out on moves in names like crypto miners like Riot Blockchain, Coinbase, MicroStrategy, Advanced Micro Devices, CrowdStrike, you know, those are the types of names that with this breakout strategy, I've owned them over the last several months, and they've been very rewarding, needless to say, in the portfolio. And all I'm doing is just following a factor-based method. And I want to share that factor-based method with you. Okay. And then we're going to cover a couple stocks that I have on my radar right now that satisfy this factor-based method. And the thing that's important to understand about this factor-based method is that all it's doing is giving you a framework in which to operate in the ever-evolving environment that is markets, right? Markets are not a static, fixed entity. They are mutable. They are constantly changing and adapting to influxes of new information and developments and economic data and headlines and whatnot. So if you don't have a method to keep you grounded in this market that exists, you know, in the ether, in the air, you're gonna have a tough time keeping up. Okay, so I'm gonna share with you that method, and I'm gonna show you some stocks that fit that criteria, but it's not as simple as, oh, look, this stock fits the criteria, so I buy it. There are rules and there are structures and there's a format that we follow that can protect you. And once you learn how to protect yourself, you can get a little aggressive, right? It's like, to use a boxing analogy, yeah, you know, to attack, you have to expose yourself a little bit, but if you expose yourself too much, you're going to get hit and you're going to go down. Okay. So it's about finding that right delicate balance. So buying the strongest stocks in the strongest sectors is the most efficient way to compound your gains over time. I've called it the consistent compounder, this method. Okay. Now, there are environments in which the breakouts won't be as lucrative. Okay. So you have to know where you are in time to understand, hey, is this an environment where I want to be getting single base hits, or should I be going for triples or home runs? Okay. The cycles help you understand where you are, because sometimes, hey, if the market's going sideways or slightly down, you know, the best breakout trades you might be getting are what I call 15 to 20% layups. Okay. But I'll take that. I'll take that if the market is sideways or slightly down. But if we're in an environment like we are now, I mean, if a stock's not offering me at least a 30 to 40% reward opportunity, I'm not even looking at it. I mean, you just look at Super Microcomputer was up 20% already today. MicroStrategy, the Bitcoin, the crypto mining stock, up 20% today at one point. So you have to know where you are in time to know how aggressive it is appropriate to be. And the timing of this couldn't be better because despite markets surging to new all-time highs here, we're entering a pretty dangerous period. And I'm not saying this is going to happen next week or even next month, but I think we are in the cusp of the biggest opportunity in financial markets going back to March of 2020. Okay. And that was the COVID crash. You had the Nasdaq crash, pretty much 40% in 1 month, historic. If you survive that, you traded through history. Congratulations. But how did you do coming out of that low? How have you been doing coming out of that low from October? Because guess what? We were backing up the truck coming out of that October low. Why? It was a certain type of cycle low, a phase cycle low within an even greater cycle. And we knew that, hey, this is probably the final phase in this bull market going back to 2020. And these final cycle phases, they can be parabolic. So right around this time, after we had this big green candlestick here, our investment strategy, our trading strategy became very aggressive. And we've just ridden this wave up, taking the portfolio to new all-time highs. Okay, so what are some of the names that we've traded along the way? So look at CrowdStrike. Now, this is a reduced position. The way I trade, when I initiate a trade, I allocate a percent of my account, typically anywhere between 5 to 10% of my portfolio. Okay, and then once my upside target is hit, I capture my initial gains, I tighten up my stop losses, and I let that stock run. If you've ever heard the saying, cut your losses short and let your winners run, I live that. That's what I live. And that's the only way to compound your account over time. But by selling a portion of your trade, okay, what you are doing is you are protecting yourself from concentration risk and from abrupt reversals in the market. Okay, so this is what CrowdStrike was at for me based on Friday's close. Okay, 78%. And what is that, 4 months? That's not bad. That's not bad. And it probably is going to have more room to run. And I've tightened up my stop loss quite a bit. So I'm protecting like 60-some% of this gain already. Okay. Here's another example. Advanced Micro Devices. Look when I was buying these stocks. Just, weeks, if not days after that market low. AMD up over 80% going back to the beginning of November. Okay, so these are the types and driving the bull market stocks. But it's not just any tech stock. Not all tech stocks are booming. What filtering criteria are we using? What filtering criteria should you use? And if you don't have it, I'm going to teach you what filtering criteria to use to find these types of names in the early phases of their breakouts. And sometimes I like to tie in a little bit of swing trading into the process with the cycles. Because when we have an idea based on the probability of a low forming, you can see when we bought Ethereum, the Ethereum trust here, not bad gains. And I've reduced this position probably 3 times. So I'm like, I have almost no principal left in this trade. This is just profits being run. Okay. And Bitcoin's about to make a new all-time high. I don't know if Ethereum will in this cycle, but it's hitting new multi-month highs. And, these are the timestamp trades that this methodology provided to get in at the right time, Okay. So the tools that we operate with generally with this methodology include the following: technical analysis. What is technical analysis? Well, I'm going to talk about that a little bit today. I'm not going to get into the details because we don't have enough time, but technical analysis is the study of price patterns, momentum indicators, trends, so on and so forth. I call it the study of the y-axis. Okay, we're studying price. But what a lot of traders and investors often neglect, to their own detriment, that I want you to understand very much so, is cyclical analysis. Why are we only studying the y-axis and looking at half the picture? Let's look at the x-axis too and study cycles. Can we go outside and observe the seasons in nature? Absolutely. So why don't markets have seasons? Doesn't human behavior change based on seasonal factors in our environment? Do we spend more time indoors in the winter and more time outdoors in the summer? I would argue so. So if our behavior is changing based on environmental factors, wouldn't that same principle carry over to markets? Do people spend more during the holiday shopping months than they do perhaps going into tax season in April? Probably. I would venture to say so. And if you look at even generally accepted financial analysis tools like seasonality, okay, even technical analysis isn't universally accepted in the financial world. And that was kind of one of my point of contentions when I was operating in the financial industry, right? Because here I am, I'm a technical analyst, I'm a cyclical analyst, and all my peers are fundamental analysts, telling me the stock market's going to crash next week based on valuations. And here I am just pointing out higher highs and higher lows in technical analysis. And we're only in the first phase of this news cycle, and we should continue rallying into the summer. And they're laughing at me. But, my clients are taking me seriously because I'm telling them, hey, you're calling me freaking out about this news event and, the economy crashing. And I'm like, no, cyclically speaking, the trends show that we're still trending up. And so there's no need to worry. Talking people out of being their own worst enemy in their portfolio and selling way too soon. These are the tools that I use. So if you want to empower yourself and take control of your own financial destiny, this is what you need to do. This is what you need to use. This is what all the top dogs are using. The fundamentals probably have not mattered this little from any time I can remember. And, some make an argument the fundamentals may start to matter again once we enter a bear market. But let's think about the opportunity cost. Are we just going to sit here on the sidelines and everyone else is going to make money hand over fist while we just sit here waiting for the world to end? That's not a very good strategy, because I've heard it said before, and I think it's very astute. The end of the world is the bullish case. If the economy collapses and the dollar becomes worthless, hypothetically, you think your portfolio is going to do anything to protect you? No, it's not. So we need to play the game. We need to know the rules, and we need to play it right, and we need to play it well. And these are the tactics, the tools, the techniques to use to do all that well. And it's not just about having the right chart reading skills. You need to know how to you need to narrow down the stocks, right? We know that the stock market has thousands and thousands of stocks, but you can't go through thousands of stocks on a daily or weekly basis. Maybe, over the course of a month you can, but let's narrow that down to 100 stocks, a couple hundred stocks. It's a lot easier to even look at, 50 stocks a day or a dozen stocks a day, or, over the weekend, if you want to do a little bit more due diligence. It's easier to narrow that list down or to run through a list that's been filtered down. So having a good stock screener is very important to becoming a good breakout trader. And ultimately, at the end of the day, practice makes perfect. Once you see it, you will not be able to unsee it. So there is an initiation to this. There is a process. Call it a ritual, if you will. And guess what? It takes time. It takes time. So let's run through some basics of technical analysis. So this is all about pattern identification. And, it's about walking a fine line. There is some room for interpretation. It is an art. Reading charts and finding chart patterns is an art. Okay, so there has to be a little bit of creativity. There has to be a room for interpretation, and you need to know when you are trying to see patterns that don't exist versus just taking the simple pattern. Okay, I break patterns down into three main categories. There are reversal patterns, continuation patterns, and momentum patterns. Now, each of these pattern types serve their purpose based on the season. Okay, so if you are late in a cycle, there's only a certain type of reversal pattern you're going to see, and it's one that's usually indicative that the uptrend is ending. But the big ones for breakout traders are continuations and momentum patterns. And I'm going to show you some examples of that right now. Has Netflix been a big breakout stock? Absolutely. But if you would have incorporated one of my favorite patterns that I do not see a lot of other traders using, even my fellow traders here at TheoTRADE, who are exceptional at what they do, I don't see a lot of traders using broadening wedges. So I'm not going to share, well, am I allowed to use the same, a similar joke from part one? I said, I'm not going to share my tomato sauce with you, but I will share my secret chart pattern sauce with you. And one of them is the broadening wedge. Okay. And so this was the buy point based on this pattern. So was this a good time to buy Netflix based on this broadening wedge? Yeah, absolutely. Absolutely. And you can see, I didn't take this trade, but this is just a theoretical, hypothetical example of how knowing when and where price patterns are forming and what that means for the momentum trajectory of a stock. Okay. Now, here's a trade that I did take on that also had a broadening wedge. It's characterized by an upper horizontal trend line that acts as technical resistance. For those of you that don't know, technical resistance is a price zone in which supply begins to overpower demand. And typically there's some selling. You can see that when, prices tested this zone here, there was some initial selling. It didn't just break right through. So you have an upper horizontal trend line acting as resistance and a downward sloping trend line connecting a few lows. Okay, so this is a unique pattern because you have kind of an expansion in volatility and an abrupt mean reversion. Okay, so I showed you the timestamp of when I bought Ethereum. It was just a couple weeks after the absolute low, and it's just been exploding to the upside. But what I had here is what I like to call the squaring of price via the price pattern and time via the cycles. Look at the cycle here. Low, low. If you go back here, there's even a low right around there as well. Okay. So this kind of tells us that, if you respect this cycle, we should have a big low coming sometime by the end of this year, maybe early next year in crypto. Okay. That doesn't mean I think we can get a pretty sharp sell-off in the next couple of months, but I think it'll be a dip buying opportunity. So the question that you need to ask yourself, if you are not happy or just simply seeking to improve your trading results, are you squaring price and time? Are you neglecting half of the picture on a financial market chart? Are you only focused on the y-axis at the expense of the x-axis? Because what this allows you to do is have the biggest profits with the least amount of risk. That's all trading is risk-reward ratios. Okay? If you're making big profits by taking big risks, I hate to say it, but at some point, one of your trades is going to go wrong and it's going to punish you. Okay? So it's all about maximizing return while minimizing risk. And many times, traders will just do that through price studies and not time studies. Okay? You don't want to be getting overly aggressive when you're late in the cycle. Okay? You want to be scaling out. It's like with my crypto trades, I've been scaling out. I've been scaling out of tech. And guess what? It makes it a lot easier to ride that wave higher when you've already taken part of your chips off the table, psychologically speaking. All we're doing is managing our emotions, right? But if you don't have the right tools to manage your emotions, it can be a little more difficult, right? So what are the methods that we use? What are the factors that we use to find these breakout trades? Well, they're right here. Here they are. Price is the number one indicator because that's all we trade. And by the way, these are not in order of significance, but price is number one for sure. Volume. Do we have evidence of accumulation? That's how markets go up. It's all accumulation versus distribution. Are there more buyers than sellers? Are there more sellers than buyers? If the former, the price of the security will go up. If the latter, the price of the security will go down. Relative strength. You've been hearing me say strongest stocks in the strongest sectors. So do you want to be buying utilities today? No. Why? Well, it's the worst sector in the S&P, and there's probably, as a result, not very many strong names in that space. Where's the strength? It's in tech. It's in communications. And believe it or not, even financials. Okay? Momentum. How do we gauge momentum? Well, momentum follows a cycle, and that kind of ties into time here. And to summarize it simply, momentum contracts before it expands. It expands before it contracts. And there's a couple tools, technical tools that you can use to see whether momentum is contracting or expanding. And then time. If you've ever heard the sayings, the bigger the base, the higher the space, or the bigger the top, the bigger the drop, you've been exposed to some concept of time in the markets. But I would venture to say it's an incomplete picture. Okay, so let's look at some basic reversal patterns, and then I'll blow them up on the next page. We can look at them. So these are just a couple. I don't want to throw too much at you right here, right now, because I want you to take, be able to take away some actual actionable price patterns after this session together. So you have rounding tops and rounding bottoms, head and shoulders. That is, representative of a market topping out and beginning a bear market. You have the inverted head and shoulders, which is a market that's been in a bearish trend, emerging from that bearish trend and beginning a bull trend. You have double tops and double bottoms and triple tops and triple bottoms. And I'm going to share this with you right now. Out of all the reversal patterns, I would say this is probably the most useless. So in markets, a lot of times it's important. It's almost as if not more important to know what not to do versus what to do. In many cases, doing nothing is the right thing to do. Your actions must be calculated and planned, not done hastily. And the reason I share this about double tops and double bottoms is I've seen them more pertinent over narrow time periods, in the sense that you see them more in congestions and consolidation zones, very rarely in big turning points in the trend. And that's where you get the biggest moves. So here's an example of a potential rounding bottom in crude oil. But I must say, I'm not really buying this pattern right now. The hypothetical buy point would be right around now. But the problem is that crude oil is getting late in its cycle. So keep an eye on this over the next couple of weeks. If this pattern fails, you'll be able to say, well, Gianni warned me because he said that we were late in the primary cycle and we were running the risk of pattern failure. So keep an eye on this. But you'll see we did have an inverted saucer here. That's kind of a momentum pattern, but looks similar to inverted saucer or a regular saucer, a rounding bottom. And you could see how, when you break the support, you get a big drop in prices and acceleration and downside momentum. Okay, so these are some of the patterns that I use each and every day in my technical analysis, and ones that you need to be doing as well. So here, look at gold. Gold just broke out. Gold's about to close at its highest level in history today. Okay, so you can see here, you're bouncing off these zones. Okay, you have support here around 2000, resistance here around 2080, 2090. You were rejected there, 3 times off support, 2-3 times. That's really as good as you're going to get for a double bottom, double top until, you actually start changing. And those aren't good patterns to trade. So I'm here to tell you something not to do is don't go out there trying to fade double tops all that aggressively, trying to buy double bottoms or triple bottoms all that aggressively. They seldom work out in your favor, especially when it comes to breakouts. Okay. How about continuations? Well, these are really important. What does a continuation pattern mean? Well, it implies a continuation of what? The trend. The trend is your friend until the trend ends. Well, Gianni, how do I know when the trend ends? Well, you have to learn cycles and you need to know where we are in time. So I took the liberty of adding that second part to that phrase, which is commonly thrown around in financial circles. The trend is your friend. Very, very good concept and whatnot. But until when? Until the trend ends. When might the trend end? When the cycle says it might. Okay. So you have the family of triangles, ascending, descending, ascending triangles, descending triangles, symmetrical triangles, and you have the price channels and rectangles. Rectangles kind of overlap with momentum patterns. I'll show you a couple examples here. Take a look at Microsoft that broke out from this continuation pattern back in January. So you have a downward sloping upper trend line that's getting more narrow, an upward sloping lower trend line that's getting more narrow. Volatility is compressing before it expands. Volatility does not need to be on the downside. It can be on the upside as well. So here you see a continuation of the trend. Higher highs and higher lows already in effect. You broke out. The trend continued. How about an ascending triangle? This, instead of a downward sloping upper trend line, it's just a horizontal upper trend line. But the theme is similar in that you have an upward sloping lower trend line. And once again, volatility is compressing. This is Vertiv Holdings. Already in an uptrend, we observe a continuation pattern. You break above resistance, and then the bull trend continues. Okay? So knowing when to buy in these continuation patterns is important, and I want to teach that to you. Okay? Don't get stuck holding a stock in a congestion zone because you are missing out on opportunities elsewhere in the market. There is opportunity cost, a very important economic principle. Remember, I was an economics student. They pounded that into our heads back in college. Momentum. I love momentum. You got the cup and handle. Bull and bear flags. Probably the best pattern to make large amounts of money in short periods of time. But I love the wedges. I love my wedges in the rectangle again. So let's look at some examples. Here's an actual stock that I called out. Unfortunately, I didn't buy it, but Viking Therapeutics. If you saw that in the headlines over the last couple of weeks, because they had a big news headline on a drug that they were using, had really good preliminary results for weight loss. Well, we issued a buy alert on Viking Therapeutics back here in mid-January. And it's just absolutely exploded to the upside. Okay. And it was a broadening wedge. Upper horizontal trend line acting as resistance, downward sloping lower trend line. Okay. Holding on some key lows. And you just get long when you start to break above resistance. Okay. And it exploded to the upside. A great trade. So, what are some stocks today that fit my criteria for a potential breakout trade? Okay. I'm going to give you the names of the stocks and the sectors they're in and the ticker symbol and the trade instructions. So like I said, just because a stock satisfies my screen doesn't mean I go out and buy it immediately. There are rules. It's on my radar. I'm watching it, but it has to do what I want to initiate a trade. It's kind of like the art of war. If you ever read that from Sun Tzu, you never interrupt your enemy when they're making a mistake, and you fight the battle on your terms. So the battle begins when I hit buy. I decide when that happens. You decide when that happens. So for Amcor Technology, I would go long on a close above $34.18, $34.18. Okay, we have to close above there. Okay, so you might, if you buy it at the close, you might buy it at $34.25. You might buy it at $35. Just keep that in mind. We're not buying it during the day, at the end of the day. The stop loss would be on a close below 31.02. I'm managing my risk within an 8% threshold, and that's on purpose. I have an upside target on Amcor Technology at $45 per share. That if prices hit that level and this trade triggers, you better believe I'll be selling 1/3, and I think you should too. I think you should too, at the very least. Maybe even sell a half. Here's another one, Oscar Health. Okay, healthcare stock. Healthcare has been a really nice sector this year. And guess what? I think biotech's about to come back too. Okay, biotech broke out from a big rounding bottom. Take a look at XBI, the chart, on your own time. But I think it's going to be a big theme. And it's really important. Why? Because the biggest sector in the S&P 500 is technology. What's the second biggest? Healthcare. So tech can't do all the heavy lifting forever. Oscar Health, ticker symbol OSCR. You want to buy this one on a close above $18.25 with a stop loss on a close below $16.79. The target to reduce this stock is at $34 per share. Last and certainly not least, Gold Fields. I issued a very rare back up the truck rating on precious metal stocks last week. But this is one that hasn't broken out yet. Gold Fields, ticker symbol GFI. It's in the gold mining sector. The trade parameters are as follows. Buy on a close above $17.40 with a stop loss on a close below 16. The target is at $24 per share to reduce. Okay, so I threw a lot at you today. And if you want to learn more, there's a great opportunity to do so. Tomorrow, we are starting a mastermind course. on how to incorporate time with price. It's all about mastering the cycles of markets. Okay, this is going to be a 6-week educational program that I want you to join me in. We're only limiting spots to 50, and there's not much space left in this program. So I really encourage you to join me. I want to take you through some of the important features of this Mastermind course. So let me go ahead and switch over from this PowerPoint. And let me see here. You can see this. So if you want to learn where we are in time and how we are on the precipice of the biggest wealth building opportunity since 2020, right now everyone's making money. But here's the question. Are they going to keep it when the cycle that is set to unfold this year culminates? And if you keep it, and even if you keep most of it, you don't need to keep all of it. If you keep most of it, and you can get in near the lows of the cycle that's set to culminate this year, it's probably the best wealth building opportunity going back to March of 2020. Okay, so we're starting tomorrow. There's not a lot of spots left, but we had a few. And, you know, I told Jeff, let's do one more workshop because we got to get as many people on the right side of time as possible. Okay, so if you want to learn more, you can reach out to our sales staff at TheoTRADE, 623-244-5657. You can book a call and get on the calendar, and our sales staff and our support team will take you through all the intricate details of what the Mastermind entails. Okay, and then if you just want to join right now, go ahead and click the link, and you can learn all about wedges and how to position yourself on the right side of momentum with time. Okay, again, the biggest opportunity over the last 4 years is on the horizon, and I think it's going to be a violent but quick pullback. You know, that pullback of 2022, that was the longest decline that we had since the global financial crisis of 2009, but it was slow. It dragged out. I don't think this one's going to be this way. I think this one's going to be very dramatic, and a lot of people are going to sell the bottom because that's just in their nature to do so. Don't be like the team that I worked with in December of 2018. Okay, we don't sell the lows. We don't sell the lows. We scale out on the way up, and then we buy the dips. Okay, so again, this is a 6-week trading intensive. This is the first class I'm doing here at TheoTRADE. A lot of popular demand. Hey, Gianni, we want to learn your cycles. You know, you nailed that low in October. You've been, saying get long precious metals. You nailed that low in cryptocurrencies as well. How are you doing this? Well, this is how we do it. We're gonna talk about this in this mastermind. And what this is gonna do is boost your win rate. Okay. You can be a profitable trader if you're right as little as 1 out of 4 times. But what happens if you can be right more than 50% of the time? What happens to your bottom line if your trade accuracy becomes over 50%? Okay, if your average winner is over 30% and your average loser is around 30, and you're right, your trade accuracy is 50% of the time, look out, guys, because your account is going to be going through the roof. Okay. Again, time is the missing indicator. Most people ignore time. It's like we build our daily lives around time, but it's like the only thing that people look at is when the market opens, when the market closes, and then a lot of people don't even look at the charts over the week. I think you. So this is going to be one-on-one time, an intimate setting with me. You'll be able to ask all of the questions that you have. I'm going to have a highly curated, intense curriculum for you. You are going to learn basically 12 years worth of experience, more than 12 years worth of experience, from the innermost circles of Wall Street to being my own trader / analyst for the last 4 years. Okay. So this is all going to be on Zoom, 1 hour a week, Q&A sessions. If you ever have any questions, if you ever have any support that's needed, once you are in this mastermind, you're at the top of my email list. You have any questions, you shoot me a note. We'll get it taken care of. Okay. It's going to start at 2 p.m., 11 a.m. Pacific. Okay. It's going to wrap up the beginning of April. And all of these sessions will be archived and recorded. So, like I said, I'm giving you a lot of information. I want you to have it. I also said earlier that it takes time to absorb. So it may be worth revisiting these video calls, these Zoom calls, once you start to, once you kind of have a foundation for it, right? And if life happens, you can't make a meeting, it's all recorded. And if you have follow-up questions, shoot me an email. I'm right there. Okay. So like I said, I started off in the investment community. Lot of nice people in the financial world, but a lot of them just don't see the picture. They don't see the patterns. And I think most people can see them if they have the proper training. And like I said, I learned this from the ground up. I didn't have an uncle that worked at Fidelity that taught me, oh, this is what you need to look at, Gianni. This is how you get started. No, it's from my own trial and error. So no matter where you are on your financial journey, whether you're an expert, whether you're an elite, or whether you're at the beginning, whether you have, a $5,000 portfolio or a $500,000 portfolio, I've worked with someone like you. I can guarantee that. Okay. When I'm not surfing markets, I do have a family. 2 under 2. It's very fun. I do love the macro stuff. So people like to know why things are happening in the market, but I like to say sentiment follows price, not the other way around. Okay. You may have seen some of my work on websites like Benzinga, Yahoo Finance, Business Insider, Nasdaq.com. I've worked with some other, institutional fund companies in the past doing some research for them. Because believe it or not, I actually have institutions that come to me periodically and say, hey, what do you see with the price action? What do you see with the cycles? We're looking for that extra edge. Well, I'm here to offer that edge with you over the next 6 weeks, starting tomorrow. So these are the main topics that we're going to discuss. Starting tomorrow, if you thought the price patterns that we looked at today was not enough, that's fine. Because I have dozens and dozens of real world examples to show you starting tomorrow on price patterns. And I wish that we could only cover that in 1 week. We're going to revisit the price patterns, specifically which ones are the best for buying breakouts throughout the whole 6-week program, because that's the foundation of this method. But we're going to add layers each week to narrow it down and improve your trade accuracy. So week 2, we're going to look at volume, how to know when volume is statistically significant or not. There are some days where there's light volume. Price does nothing. There's some days where there's very high volume after a headline and price still does nothing. But what happens when you have high volume and big price movements? What does that mean, especially as it pertains to a particular price pattern? Okay. Financial Darwinism. The strong get stronger and the weak get weaker. You think it's a coincidence that NVIDIA keeps eating the stock market? You think it's a coincidence that supermicrocomputer is booming? You think it's a coincidence that these crypto mining stocks are doing so well as Bitcoin hits it's about to hit an all-time high? No, it's not. It's because of financial Darwinism. The strong get stronger and the weak get weaker. Momentum. I don't want to buy a stock that's in sideways mode. I want a stock that is increasing side momentum. There are tools and techniques to do that. And then last and certainly not least, the cycles. The bigger the base, the higher the space. Okay. The bigger the top, the bigger the drop. Where are you in time? Are you in the 2nd week, for example, of a new primary cycle? Are you in the 20th week in a 50-week cycle? Where are you in the 4-year cycle? Where are you in the 18-year cycle? What does that even mean? Well, we're going to talk about that in this mastermind. Okay. 6 weeks, crash course. Okay. And we look at the most liquid names. Okay. That's another thing too, is that I really think it's important to trade liquids. You don't need penny stocks. If you want to trade with leverage, if you want big price moves, look at options, look at futures. Okay. Penny stocks are priced accordingly for a reason. Okay. Knowing when to buy, know when to hold them, know when to fold them, know when to walk away, know when to run. And despite not being able to transmit 12 years of experience into 6 weeks. What it will absolutely do is give you a foundation to continue your studies. Okay. So I want you to avoid that ground zero place that I started at. Why? I did the work. I'll tell you, you can skip this stuff, focus on that, and go right to this. If you want to make money, which is our #1 priority in this market, this is what you need to do. And then develop your own plan. I want you to be able to analyze markets on your own and find your own trading setups. That is the ultimate goal of this mastermind. Okay. So again, schedule a call with our TheoTRADE team if you want to learn more and find out all the details. Okay. We have time slots available on our scheduler here. Okay. And you might ask, why are you doing this? Well, I did not grow up in a mass mass affluence. I was definitely not hurting. Always had a roof over my head. Middle class family. Dad worked in the cement business. Mom worked in the auto industry. My grandparents helped us out quite a bit. Never had to worry about food, that kind of stuff. Very, very middle class lifestyle. But I think that's a big part of what America is all about, is building and growing and moving forward generation after generation. So I think this was a logical step in my own family's legacy. And I would like to think, even as a father myself, that I would like my children to have it better than I did, right? And so whether you're a grandparent or you're a young professional and you have ambitions when it comes to legacy, learn how to take your own finances into your own hands. Okay, so we are educators here at TheoTRADE. We put our money where our mouth is. We trade our own accounts, and we want to empower you to do the same thing too. Okay, the markets are not going to get any easier in the future. There's more retail participation, for better or for worse. There's more liquidity, but there's also more chaos. And so you need to know how to protect yourself from those situations. Okay, so we're only limiting this to 50 people, 6 weeks. It's an intimate setting. Your questions will be answered. And like I said, start this off, book a call with our sales team, and I hope to see you in our mastermind. So no matter where you are in your journey, beginner, intermediate, and advanced, I can relate to you. Okay. And that is a very powerful thing, because I can speak your language wherever you are from. I speak 3 languages. I speak Italian, French, and English, and I speak trading too. So if you need to know what a reverse split is, what that means, if you need to know what accumulation is, if you're worried about mean reversions, no matter where you are on your trading journey, we can connect. Okay. So before we wrap this up here in a little bit, I would like to answer some questions in the chat. So let me jump back over to the PowerPoint. Are you ready to learn how to compound consistently? If so, I hope to see you in the mastermind that starts tomorrow. Okay. Let me see here. Going through the chart. It should be on the website. Yeah, so Shady Trader, there is some IBD strategies in here, but IBD does not use cycles. And they also don't look at the momentum oscillators like I do, and other volatility signals. So it's basically refined. Would this be suited for option trading? Well, I don't trade options personally, but you can definitely apply this method to option traders. I work with a lot of option traders. Over the years, I've had plenty of people that trade my breakout names with options. And so, yeah, you can definitely do that. It's just I don't trade those options myself. I trade futures and I trade stocks. And for me, I like the futures market better than options. So to each their own. Am I on a 1-year chart? For the ones that I showed you, yes. But I use different time lengths based on whether I'm looking at a daily, weekly, or monthly chart. The gold stock was ticker symbol GFI. Tim asks, can you define a cycle? A cycle is an event that recurs at a generally predictable interval. So it's like, that summer is generally going to start in the Northern Hemisphere around June 21st. Okay. Fall will generally start around September 21st. Okay. Atul, yes, there is a recording for this. Yeah, Jay, so we definitely will look at examples, especially in the price patterns, for stocks that have shorting opportunities. Okay, so I generally trade in the direction of the underlying trend. But like, for example, Tesla's been breaking down from a big pattern. We covered that. We analyzed that in great depth a few weeks ago. And so, yeah, if you are a trader looking to short, this technique, this method does give you the tools to increase your accuracy on that. So, James, for the S&P right now through the end of the year, we probably will end higher, but not without a significant, let's call it an event of volatility, a volatility event. With the way stocks have been trading now, I'm not going to rule out a 15 to 20% pullback at some point. Okay. Yep, just going through here. Yeah, I don't think that IBD uses the same cycles as me. This was recorded then, yep. This course is 1 hour a week. Yes, there is a Q&A, so it's a 1 hour of material and then a Q&A session each time as well. Why is my win-loss 61.3%, but I lose money? Well, it's because your winners aren't big enough. Your winners need to be big enough. And then what are your losers? So, if they're similar and you're right more than you're wrong, then, that's unfortunately going to weigh down on your performance. My analysis is different from Slim's. Slim's, of my understanding, I don't understand Slim's entirely, but I think he works a little bit more on seasonal factors. Let's see. Yeah, so to do cycles, Gerard, in thinkorswim, it's a chart study. So you go to chart studies and you go to the drawing tools and you click cycle brackets. Okay. So Ralph, you will get a Zoom link to attend the mastermind. I believe it comes out the day of. So that pretty much takes us to the end of today's presentation. Thanks so much again for joining me. I really hope to see you in the mastermind. It's a great place to get your questions answered and to build on your trading experience, regardless of whatever level you are on. So that's all for now, everyone. Gianni DePoce signing off. I hope to see you tomorrow starting at 2 p.m. Eastern. And if not, I will definitely see you around sooner or later. Take care, everyone. Thank you.